Have you been wondering about when to sell a stock as a long-term investor? Well, in this video, I'll show you exactly what parameters to look at before you make a selling decision. Hey guys, welcome to my channel Investing Untangled. Hope you're all doing well. On this channel, I post videos about stock market research, detailed stock analysis, and also educational videos on stock market investing. And if this is something that interests you, then hit the notification bell and the subscribe button and follow my content here. This is an educational video on stock market investing, and I'll show you in this video the parameters that you should look at before you make a selling decision. I have myself read dozens of books on stock market investing, especially focused on value investing, and I closely follow top value investors in the world and what moves they are making in the stock market. This helps us a lot as value investors to learn from the big guys what they are doing and to understand the thought process of why they're doing what they're doing. I myself use these three factors to govern my own selling decisions, and I've learned this from a number of different value investing books. The basic notion of value investing and long-term investing is that you buy and hold a stock forever, but that doesn't generally work out that way. Big investors and very famous investors like Warren Buffett also sell their holdings from time to time. And here I'll show you the factors that they look at that guide them to a selling decision. So this is going to be a value-packed video, and in return, if you can leave a like on this video, that'll help my channel a lot. So without further ado, let's get started. You should always base your sell decisions on three parameters that I'll discuss in here. So number one is qualitative fundamentals have changed. For example, there is new competition that has emerged that is eroding the moat, the competitive advantage of the business that you bought. And a classic example of that is retail industry is being hammered by e-commerce giants like Amazon, and a lot of these retail industry players are struggling. Another interesting example is how the ride-sharing business is actually massively hampering the growth of taxi operators. So for example, if you look at this chart here, you see that the taxi business has been on the decline, this yellow line here, and the ride-sharing companies like Uber and Lyft are increasing their market share in this space. Last year, it was a pretty dramatic fall for both these players, but in general, taxi businesses have been actually struggling, and Uber and Lyft have been taking their market share. And this is what I mean when I say competition is eroding the business, meaning that the business model is not as attractive as it was why you picked it in the first place. So the whole business model has changed. And in that case, you should definitely consider selling your position and looking for some other better opportunity. The next point is if there have been regulations or laws that have been put in place that impact the business that you own. For example, big companies like Facebook, Alibaba, Google have been hit by these antitrust monopolistic regulations, and that has hit their stock multiple times. And this can be a problem if there is a permanent law that has been put in place now that will impact these businesses. So far, these businesses have been okay because they've just paid fines and they'll continue to move on the way they were doing before. But if there is a strict regulation that is passed and a law is passed which drastically impacts the business model, then you should think if the competitive advantage of that business is still maintained. For example, if Facebook is forced to divest and sell off branches of its business like WhatsApp, like Instagram, etc., then it's not a very attractive business because that will hamper its revenues, its growth going forward, and it loses its competitive advantage. And that would be a reason why you might consider selling this stock. The third point is management is incapable. So it can be that the company decides, the board of directors decide to basically change the management. There is suddenly a new CEO taking over and they're not doing a good job in terms of allocating capital, and they're not really getting great returns on the capital. And that can be actually a reason why you want to sell out of that position. Here I'll give you an example of what a great management team can do to really turn around a company. Let's check the example of Microsoft. Microsoft changed its CEO in 2014, and Steve Ballmer, who was the previous CEO, was replaced by Satya Nadella. And since then, you can see what has happened to the stock price. Microsoft had flatlined in all these years, and in 2014, they changed their CEO. And since then, the stock actually rocketed upwards. And right now, it is a $1.76 trillion company. And here you see when Satya Nadella actually took over this company, it was a $300 billion company. So in just a matter of 6-7 years, he turned around the company so much that it is now a $1.7 trillion company. He has actually diversified its revenue streams. They are pretty big in cloud now. They've also made very critical acquisitions like LinkedIn, and all these things have brought in a lot of money and have expanded its market cap. So this is what a change in the management can do to a company which has been struggling for a while. And it can also go the other way around. So if there is bad management, if there is a new CEO who is not behaving responsibly and who is putting his own interests in the forefront, that can hit the stock price and that can actually shrink the market cap. So it is a very important factor that you have to look at. If the management is incapable, just come out of that position. And finally, the last factor is new unexpected circumstances have risen that lead to massive uncertainty in the business model. Let's consider another example. Last year, Warren Buffett sold all his airline stakes, and I listened through the entire annual meeting. It was almost like a 4 or 5 hour annual meeting, and it was very interesting to see how he thought about the airline industry. And here you can see this article has quoted him, and he said the world has actually changed for the aviation industry. So what he means with that is that there is extreme uncertainty now when the travel will become normal again, when these restrictions will be lifted. A lot of these airline companies have raised a lot of debt to stay afloat, and it will take them time to pay off a lot of this debt and generate good returns for shareholders. And that is a very good reason to come out of that position and sell it off. Now we will look at quantitative factors. So quantitative fundamentals have changed, and these ones are generally easy to spot. So you can see revenues and net income have been declining, cash flows are declining, operating cash flow, free cash flow is declining, shareholders equity has been shrinking, so book value is going down, return on equity, return on invested capital are becoming worse than what they were before, and profit margins are shrinking, debt is going up. So all these factors, if you see these things happening in your business, it's better to come out of that business immediately, because all these factors will later on reflect in the stock price. And if this is how the company is going forward, the stock will go down. I've explained all these metrics in detail and how you should look at them and what should be your threshold for these numbers in another video that might be interesting for you to check out. I'm linking that in the description below. Now here also I want to illustrate it with an example. So let's take examples of Facebook and GE. So this is the Facebook stock page on Yahoo Finance, and here you can see around 2017-2018 Facebook crashed pretty massively, all the way from around $200 to $130. And that's a pretty big drop. So a lot of investors who were invested in Facebook panicked, and they just panic sold out of it. But if you see, that was actually a mistake, because the price rocketed upwards after this time. So this illustrates the point that you should never make a sell decision just based off of the price of a stock. And I'll show you what I mean with that. So around 2017-2018, when this crash happened, let's look at what Facebook was doing as a business. So from 2017 to 2018, the revenues actually went up from $40 billion to $55 billion. Net income also went up from $15 billion to $22 billion. Book value per share, so shareholders' equity, also went up from $24 per share to $28 per share. Operating cash flow went from $24 billion to $29 billion. So here you see that Facebook was actually doing much better than what its stock price represented. Just that they were caught up in this Cambridge Analytica scandal, and a lot of investors panicked and they sold out of their positions and left Facebook, but then clearly it was the wrong decision. So whenever there is a price drop, you should look at these underlying numbers and figure out what the business is actually doing. So in this case, Facebook as a business was actually growing and it posted better numbers than the years before. So that means if you were a seller at this dip, you were not being critical as an investor. This dip was actually a great buying opportunity, because Facebook is a business which has a very strong competitive advantage and good growth going forward. Now let's look at another business. So we'll look at General Electric, GE. And here you see in the last 5 years, the price of the stock has been actually tumbling downwards. Now, should you panic with this price drop? Well, at this point, you don't know. Just by looking at the price, it does not tell you the whole story. Let's look at the underlying numbers. Okay, looking at the revenues in the last 5 years, from $119 billion, right now they're at $79 billion. So clearly their revenues are going down. Net income went from $8.8 billion to to $5.7 billion, and many of these years actually in between they reported negative earnings, which is a big red flag. Book value went from $9.37 per share to $4.05 per share. So clearly a massive reduction there also. And operating cash flows have also not been very consistent. It's a very fluctuating trend that they're following. So clearly from all these numbers, you see that GE has not been doing well in the last 6 years, 5 years or so. And that you can see also in its stock price. It has been consistently going down. So in this case, it would actually have been smart to sell off GE and then put that money in Facebook when the stock price dropped. So whenever you see a big price drop, do not panic and do not panic sell. Look at the underlying business. And what is also important is if you're following value investing principles, you would buy a company at a big margin of safety to its intrinsic value, meaning it's at a big discount. So if you look at the Facebook stock again, you wouldn't be a buyer at these prices here when it was close to $200. So clearly, if you're not a buyer there, this crash doesn't influence you so much. But you would have actually been a buyer right here as a value investor. So clearly the downside is limited going forward. So that's why if you follow value investing principles strictly, there is very little panic involved. Okay, so this was the second factor. Quantitative fundamentals have changed. The third factor is the company has become overvalued and massively overvalued. The way you look at that is by looking at valuation models and valuation ratios, and also by calculating intrinsic value. So I have explained these things in very great detail in a previous video, and I'm linking that also in the description below for you to check out what price should you pay for a stock and how to value a company. So you should look at price to earnings, price to sales, price to book, price to free cash flow, and price to earnings to projected earnings growth. If all these valuation metrics and intrinsic value of the company, the calculation that you did, if all these things suggest that the company has become massively overvalued, that's the time when you can think of selling the stock. But not just yet, because you should see if the current valuation justifies future growth prospects. It could be that the company becomes highly overvalued, but if you foresee that actually this company has very strong growth going forward, they will expand their business, and this is just a fraction of the revenues that they're making right now, they will massively expand their revenues, etc., then you know that this company has good growth going forward and you can stay back and hold it. I'll illustrate this also with an example. And in this case, let's take an example of Apple. So if you look at the Apple stock, it is trading right now at $125. A few days ago, it was in the 140s range, so it was even higher than what it is right now. And here you can see already that the analysts think that this stock is significantly overvalued. And at Guru Focus here, the analysts are estimating that its fair price is around $83. So if you look at the valuation rank of Apple, it has only 1 out of 10. Which is a very poor valuation rank, meaning this company is very expensive at these prices. And here are the metrics that I was just talking about. So its price to earnings ratio is almost 34. Forward PE is 29. And this is a company which is not a very strong growth company anymore. So I don't think forward PE of 29.3 for Apple is justified given their slow growth going forward. So it's not a big, massive growth giant anymore. Here you see price to book of 32, price to sales of 7, the price to free cash flow of 27 is extremely high. Again, this metric also shows that Apple is significantly overvalued. I generally like companies where the price to free cash flow is around 10 or even lower. And look at this PEG ratio here. So this is price to earnings to future growth projection ratio, meaning the higher the future growth potential of the company, the lower this ratio will be. I generally like companies that have a PEG ratio of lower than 1. And here you can see Apple is extremely overvalued at these numbers. And I'm not alone believing that Apple is overvalued. The best investor in the world, Warren Buffett, has been actually selling Apple in the last 2 quarters. And here you see Warren Buffett actually reduced his Apple share in his portfolio by 6% in the last quarter, and also sold Apple in the third quarter of 2020. So clearly Warren Buffett believes that Apple is at an insane valuation right now, which is not justified by the future growth potential that this company has. So to recap, you look at the qualitative factors, you look at the quantitative factors, and you look at the valuation. And this is how you make a sell decision. Let me know in the comments below what kind of a thought process and analysis do you go through before you make a selling decision, and I'll be sure to follow up with you. If you thought this video was helpful for you, please consider leaving a like and subscribe to this channel, Investing Untangled. That'll help my channel a lot. In the future, I'll be bringing in more educational videos like this and detailed stock analysis and also investing opportunities in the stock market. So until then, stay safe and I'll see you in my next video.